Welcome students, welcome to the Accountancy Point where we study the various accounting concepts for class 11 and 12. Today I have come with a new topic to begin with related to accounting for class 11. Children, the accounting procedures in the previous videos we have already discussed about what is accounting, accountancy, bookkeeping. We have discussed about the various ways of the features of accounting, the concepts of accounting, the basic accounting terms, various debtors, creditors, everything we have done. We also have discussed that the business transactions need to be recorded. Now the question is why? Why do we need to record the business transactions? For that also we had discussed in the previous video that in order to substitute the human memory, we want to record the business transactions because the number of business transactions when increase in size, it becomes very difficult for a human being to remember all those business transactions. Besides that, we also want to know about the result of the business for which we have been doing it. All of us very well know that business is undertaken with a motive to earn profit. So these business transactions will be needed to ascertain the amount of profit during a particular year. But the question is, what if I know the profit of the current year? That means if I have known the profit, suppose this year I made a profit of rupees 10 lakhs, will I be able to say that I have made sufficient profit? I have grown over the previous years. So what is needed is the profit of one particular year is not sufficient to measure your efficiency. You have to compare it with the previous year's profit. Or you may compare your profit with the organizations in the same industry. Or you may compare your profits with the profit of some other industry or the organizations. Now, when you compare the profits with two or different companies, there must be a balance. There must be something common. There must be the way in which you have recorded the business transactions. The other also must record the business transactions in the same manner, following the same concept, following the same methodology. If there will be variation, leave about the other organization. If you have been following a particular method this year and you will go to the next year and you follow another method next year, so the profit which you will earn this year and the profit which you will earn next year, you will not be able to compare. You cannot put them on the same platform and you cannot compare it. So there is a need of uniformity. So based on this particular uniformity, children, today we are going to discuss about the accounting principles. These similar principles, these similar concepts are considered as accounting principles. So today the topic of our video number 4 is accounting principles called GAAP, generally accepted accounting principles. This is part 1 of this because it's a very long, there are many concepts which we have to study. So we will be discussing in the various phases. Today the topic of discussion is accounting principle. Let us understand first of all what is accounting principle. Accounting principles are such rules or statements or standards. Rules or standards. They are those rules and they are those standards on the basis of which accounting statements are prepared. The various accounting statements like trading account, profit and loss account, balance sheet, they all are prepared on the basis of these rules and standards. These rules are called GAAP or generally accepted accounting principles. They are accepted all over the world as general guidelines for preparing the financial statements. As I told you children, that there is a need of uniformity. If the methodology, if the accounting principles which are followed by me will not be same, sorry, if they will not be same with the others, we will not be able to compare where we stand. So those rules, those accounting principles are referred as the generally accepted accounting principles, and they have been widely used and accepted all over the world. These accounting statements are used by the various users of accounting. In my previous video number 1, I had discussed with you all who all are the various users of accounting. If you all have not gone through video number 1, the link is shared in the description column. Please go through video number 1. Features of accounting principles. Children, the accounting principles are man-made because they are made by the accountants with a consent, with widely accepted consent over by the accountants all over the world, and that is why they are man-made. Accounting principles are uniform set of rules. They are uniform set of rules because they are accepted all over the world. Everyone, whether it is the steel industry or the cotton industry or any other industry, everyone, all the companies, all the industries follow these rules and regulations. They are flexible. That is another feature which we have to understand, because these accounting principles have to be updated with the changes in the time. If these these applications or these accounting principles will not be updated with time, what will happen is, with the growth of the business, the need of the business may change, and if we do not change these accounting principles, we will not be able to match our expectations and business requirement with the accounting requirements. Need of accounting principles. Why do we need to follow these accounting principles? To make accounting information meaningful to internal and external users of accounting. And it is also needed to compare the accounting statements. As I had told you in the very beginning itself, that accounting principles help us to compare the profit of our organization with the previous year's profit, or with some other organization, external resources. Kinds of accounting principles. Children, there are two kinds of accounting principles which we will be studying in this particular chapter. They are the accounting concepts or assumptions and accounting conventions. Let us discuss about them individually. First, accounting concepts or assumptions. Children, let us understand first of all these two, then we will study about the various other accounting concepts. In order to make the accounting language convey same meaning to all people and to make it more meaningful, most of the accountants have agreed on a number of concepts which are usually followed for preparing financial statements. These concepts are called accounting concepts. These concepts guide how transactions should be recorded and reported. Once again, children, accounting concepts, as they are those concepts which have been widely used by all the companies, all the organization, across all the form of business organization, no matter into which industry do a particular firm or an organization belong to. They all follow these concepts and they are widely used all over the world. Whereas when we talk about accounting conventions are those which differ from one organization to the other organization, or from one industry to the other industry. They are based on the consultation with the people all around, and especially the accountants. So these are customs or generally accepted practice which is adopted either by general agreement or common consent among accountants. So children, accounting concepts, they do not vary, whereas accounting conventions may vary from one organization to the other. Let us first of all understand the difference between these two. Legal position, accounting concepts have legal acceptance. That means they are legally accepted all over the world, whereas accounting conventions may or may not be legally accepted as they are based upon some usage or general agreement. It varies with the consent of the accountants. So it may not have legal consent applications as the accounting concepts have. Recording or transactions or versus financial statements. Transactions are recorded and reported based on such concepts. Children, you have to understand and please recorded and reported. Recording and reporting means reporting the results to the various accounting users, whereas they help in preparing profit and loss account and the balance sheet. Role of personal judgment. In case of accounting concepts, you may not need any personal judgment because they are the set rules which you have to follow as an accountant. But in case of accounting convention, you may make certain modifications based on the requirement of your business or your industry. So personal judgment may have important role to play while preparing profit and loss account and the balance sheet. Uniformity, they are uniformly adopted. That means accounting concepts are adopted by all the organizations uniformly, without any hesitation, without a question mark. Everybody has to follow it. But the accounting conventions differ from business to business based on their own requirements. So these were some of the differences between accounting concepts and conventions. Now we will start studying about the various accounting concepts. So children, these are the accounting principles as per Accounting Standard 1. Accounting standards are those standards which are fixed by the accountants at the international level. Okay, so all of them set these principles. First, accounting principles, or you can say the concepts and assumptions. So the first accounting concept is the going concern concept. Now, let us first of all understand what this concept actually means. All of us, before I begin explaining this particular concept, a small question. Will you, suppose you are an investor, you want to invest money somewhere in order to earn profit. Now, the question is, will you be interested to invest your money in such a business organization which is going to be closed down after a few months, or in such an organization where you are not certain whether the organization will continue for a very long period of time or not? Will you? The answer will be obviously no. We want to invest in such a business organization which will continue for a long period of time and will give a proper return, proper profit, benefit to the investors, to us. So, in our mind, this is the concept that when business will continue for a very long period of time, in those business organizations only, we try to make or create investments. So children, according to this particular concept, the going concern concept says that business will continue for an indefinite period of time, or the business may end up after a year or 2 or 5. We may not know, we don't know. But we assume as an accountant that the business will continue for a very long period of time, and it will give us a return, a profit in the long run or till a long run. Now, it is because of this particular concept that we are able to create a borderline between the current assets and non-current assets. Current assets are those assets which can be converted into cash within 12 months, and non-current assets are those which can be converted into, which will continue for a very long period of time. So if business is for a very short span of time, say for 6 months or 1 year, you will not be able to distinguish between the current assets and the non-current assets, because all the assets will be converted into cash within a year. So it is because of this particular concept that we are able to draw a line and distinguish between current assets and current liabilities, and also between the current assets and non-current assets, and current liabilities and non-current liabilities. So let us understand what this writes. It says that business will continue to exist for a long period in future. It is on this concept that we record fixed assets at original cost. Children, this is an important thing to be understood. Fixed assets are recorded at original cost. See children, fixed assets, why do we buy? We buy to use them for a very long period of time. We don't buy them for the resale purpose. So since we don't want to convert them into cash, so we don't consider the market value. What will be the realizable value is a matter of no concern for us. We know that the fixed assets which we have purchased, like land, building, plant, machinery, furniture, fixtures, they will continue for a very long period of time. And that is why we show them in the books of accounts at their original cost. But that does not mean that year after year it will be shown at the same value. When the assets will be used, there will be a reduction in their value. So depreciation will be charged. So every year we keep depreciating the assets from the value which is, let's suppose a machine was purchased for 5 lakhs. First year the value 50,000 was depreciated. So 5 lakhs minus 50,000, 4 lakh 50,000 we will record. Next year we will once again deduct the depreciation and the remaining value will be shown as the assets. So it is because of this particular concept that depreciation is charged on these assets without reference to their market value, as I told you. It is also because of this concept that outside parties enter into long-term contracts. At the very beginning of this particular concept, I told you that the investors, the financiers, the creditors, they are ready to provide money. Why? Because they know that business will continue for a longer period of time. They give loan and purchase shares and debentures, assuming that the business will continue for a longer period of time. Because of this concept, we are able to distinguish between current assets and non-current assets, and short-term and long-term liabilities. Short-term means current liabilities, long-term means non-current liabilities. So this is what about your going concern concept. Now the second accounting concept is the consistency concept. Now what is consistency concept? As the name suggests, consistent. Something which remains consistent, which is used at the same situation year after year. So according to this concept, or according to this accounting concept, we say that whichever system or whatever method a businessman or an accountant follows for recording the business transactions must be used continuously for a sufficiently longer period of time. Because if you will change the methods year after year, you will not be able to compare your profit of the current year with the previous years, because the method of the previous years may be different from the current year. And in that case, you will not be able to take necessary managerial decisions, whether expenses have grown up, why have they gone up, how to reduce them. You will not be able to take a proper decision. Why? Because the methods have been different. But that does not mean that you will follow the same concept, throughout the lifespan of the business. In that case, the accounting concepts will become rigid. non-flexible. And as we had discussed in the very beginning of this particular concept, that accounting principles are flexible and business keeps on changing. So with the changes, you have to adopt the changes because the technology changes, the business method changes, the environment of the business change. So with these all changes, the accounting procedure, accounting methods have to be changed. But according to this concept, whichever method you follow must be followed for a sufficiently longer period of time so that you are able to compare your positions with the previous positions or profits of the previous years or to the other business organizations. This is what it has been written over here. Let us just read. Accounting concepts and methods should remain consistent from one year to another. These should not be changed every year in order to enable the management to compare profit and loss account and the balance sheet of the different periods and take managerial decisions based on them. If an enterprise adopts different accounting principles in 2 different years, the profit may not be comparable. For example, if an organization follows SLM method means straight line method. There are various methods to charge depreciation on the fixed assets. One of the method is SLM, that is a straight line method. The other one is WDV, that is written down value method. So if the business organization will change these methods very frequently, it will not be able to say whether the true nature of the profit or the loss of the organization. In that case, accounting will become rigid. So that is what this concept does not mean that we should follow same concept always. In that case, accounting will become rigid. With the improvement in business, techniques method should be changed. But keeping in mind, whichever method is followed should be followed for a sufficiently longer period of time. Now, the third accounting concept is the accounting entity concept. Children, business and businessmen are considered 2 separate entities. Both of them are separate. Business is separate, businessman is separate. The properties of businessman is his, it is not of the business. And the properties of the business is of the business, it is not of the businessman. If businessman contributes anything to the business, that is considered as capital and he may withdraw it at any point of time. So the capital which is invested by the businessman is considered a liability because of this particular concept of business entity. And it is also because of this that the business pays interest on capital to the businessman. Suppose if businessman would not have invested in the business, he would have taken money from somewhere. So it was a liability in that case if businessman takes a loan from bank. So bank loan is a liability for the business. Similarly, instead of taking from the bank, the businessman or the business is getting the investment from the businessman. So that can be withdrawn by the businessman at point of time and the business will have to return it. So this is considered as a liability for the business. And the interest which is paid by the business to the businessman is considered an expense. Why? Because it reduces the profit of the business. So according to this particular concept, business is treated as a unit separate and distinct from its owners. Owners and that is business and businessmen are 2 separate units. Not only they, the creditors, managers, they do not have any right over the business. Business unit should have a completely separate set of books and we have to record the business transactions from the point of view of the business. Suppose if I say goods were sold, who sold the goods? It was not the businessman, it was the business. Capital was invested into the business. So who received the capital? The business received the capital, not the businessman. Similarly, if I, rupees 50,000 was received, who received it? The business, not the businessman. And that is why, as I told you, that it is because of this concept that the capital contributed by the owner is considered a liability for the firm, and the interest on capital is treated as an expense. It is because it reduces the profit of the firm. Similarly, the amount withdrawn by the owner is treated as drawings. This concept enables the owner's property to be kept and considered separate and not business property, nor business properties belong to the businessman. That means, while recording the business transactions, both of the things are kept separate. If you will merge them together, you will not be able to say whether the profit which you have got belongs to the business or to the businessman, because you have mingled everything. So in order to know the true profit or loss, it is necessary that there must be a clear distinction made and between the business and the businessman. The next concept which we are going to cover up is the accrual concept. This is the another accounting concept, accrual. Children, according to this concept, the business transactions are recorded. It applies equally to revenue and expenses. That means the revenue and expenses of the business, for both the purposes, you need this. Accrual concept, if I explain in very short, I will say that accrual concept means record the business transactions as and when, in whichever accounting year they have taken place, irrespective whether you have received cash or not, or paid cash or not. For example, salary for the month March 2020 belongs to the accounting year 2019 and 20. So the March salary 2020 belongs to this year. If the firm has not paid salary, then also it will be recorded in this particular year, because the salary was to be paid in this particular month, not in April. Even if they have been paid in April 2020, it will be recorded, it will be said that in March 2020 salary was due. It was not paid, but it was due. And you will have to pass entry in the month of March 2020 saying that salary is due, it is outstanding, it has not been paid. If it is paid in April, once again there will be an entry passed to record the payment of salary. Similarly, if sales has been made, if you have sold goods in the month of March 2020, it has to be recorded in the month of March itself, no matter whether it was sold for cash or credit. If it was sold for cash, well and fine. If not, then in the March it will be recorded as a credit sale, and whenever the payment will be received, it will be recorded once again. So this particular concept says that in accrual concept, revenue is recorded when sales are made or services rendered, not when cash was received. Similarly, expenses are recorded when they became due, not when they were actually paid. To ascertain true profit or loss and to show the true financial position, transactions are recorded in the same accounting year when they became due, not when cash was received or paid. So according to this concept, we ignore cash. This concept is also known as matching concept. We match the revenue of one accounting period with the expenses of the same accounting period. Now we will go with the another concept. This is accounting concept number 5, which says money measurement concept. Children, according to this concept, only those transactions will be recorded in the books of accounts which can be measured in terms of money. We must remember that money is a unit which is used to record business transactions. So only those transactions and events are recorded in accounting which can be expressed in terms of money, and an event, even though it may be very important for business, will not be recorded in the books of accounts unless its effect can be measured in money terms with a fair degree of accuracy. This particular concept clearly says that only those business transactions will be recorded which can be expressed in terms of money. A very simple example I would like to give, which I have written over here, is that accounting doesn't record a quarrel between the production manager and sales manager. Similarly, you can give another example that suppose there is a staff who is working in your organization, an employee, and because of him, there were too many customers coming up to your business. Because of his nature, because of his ability to handle the customers. Now, since he has left, many customers are not coming to your business to buy the commodities. So you will not be able to record this loss. You will not be able to record this particular condition in your business because it cannot be expressed in monetary terms. The another accounting concept which we are going to discuss, this is the last concept which we are going to discuss today. It is the accounting period concept. As the business is intended to continue for a longer period of time. Children, all of us very well know that why do we want to do business? We want to do business in order to earn profit. But what if, suppose I have been doing business for a sufficiently longer period of time, say 20 years I have done the business. And in these 20 years I did not bother to find out whether I have been earning a profit or earning a loss. After 20 years I suddenly woke up and thought of calculating the profit. And when I calculated, I found that there is no profit. The organization has been in a complete loss. So in that case, will I be able to take necessary step to correct myself? No, it will be useless. My capital has gone, there is no product in the business, left out because of the loss, and I'm completely ruined. So that is what it says, that in order to the true results of the business operations can be ascertained only when the business is completely wound up. But ascertainment of profit after a very long period of time will be of little or no use to the managers, owners, investors, or the other users of accounting, because no corrective measures can be taken. So the result of the business transactions must be calculated at frequent interval of time. Now, how much will be this interval of time is a matter to understand. The period for accounting measurement of profit should not be very long, and it should not be very small also. If you will try to find out the profit or loss after every month, you will not be able to judge whether you have been doing right or wrong. Because whatever action, suppose this month you were in a loss, so you took certain steps. Now that step will take some time to give you profit. But if the time interval is too small, you will not be able to measure your correct profit. So the accounting period should neither be too long nor it should be too short. And that is why the entire lifespan of the business is broken into small but sufficiently longer time interval. That is what I am saying. It should be small. It should be small in order to understand and give you the correct profit. And at the same time, it should not be sufficiently longer time. It should not be too long also. So when we do this, we are able to measure the profit of the business. That is why 12 months have been adopted or has been taken for this purpose, because within 12 months we are able to find out whether we have been earning profit or loss. Whatever actions, whatever decisions we take, they start yielding profit after a sufficiently longer period of time, within 12 months. So even the income tax department has given a necessary guideline according to which all business must or compulsory to adopt financial year as its accounting period or accounting year, which starts from 1st April and ends on 31st March in the next calendar year. For example, this financial year started from 1st April 2020 and will end on 31st March 2021. This is, children, is known as financial year. But we also have another year that is called calendar year. Calendar year is from 1st April to 31st December 2020. So in business, as per the income tax authority, we are not supposed to follow the calendar year. We are supposed to follow the financial year, which starts from 1st April and ends on 31st March of the next calendar year. So this is what is the accounting period concept. Hope you will like the video and understand these concepts. In the next part, I will be continuing with the many more concepts, and hope you will like all of them. Do take good care of yourself, and please watch the full video in order to understand the concept clearly. Like, share, comment, and don't forget to subscribe to Accountancy Point. Thank you.